Radixas, welcome to our Financial Facts channel. We Radixas will give you some valuable tips and tricks on how you can make yourself financially independent regardless of what you earn now and where you live now. Today we are going to discuss 6 major mistakes investors should avoid. Number 1. Not having clear investment goals. If you don't know where you are going, you might wind up someplace else by Yogi Berra. Without a plan, you could get lucky, but the odds are against it. Without a goal and a good plan for meeting those goals, you probably won't end up where you want to be financially in either the short or long term. You have to make goals to meet goals. Number 2. Failing to diversify enough. Invest money across completely different types of assets like cash, bond, stocks, real estates. Historically, bonds do well when stocks take a dive and vice versa. The problem is that most people don't diversify very much across different sectors and different countries. Number 3. Focusing on the wrong kind of performance. The stock market can jump or drop multiple percentage points in a single day, and that can be a really bumpy ride for some people. If you have $100,000 in the stock market and it drops 4% in a day, you have just lost $4,000. That's enough to make some people panic. The thing is, if you are invested in the stock market, the short term shouldn't matter at all to you. What matters is a long term, and over the long term, the stock market has a fairly steady upward trend. If you push the panic button because of one day down or 1 week down or even a 1 year down, you're going to end up hurting yourself big time. Number 4. Buying high and selling low. Many people's instinct tell them to buy stock after a day or a week where they have done really well. For an instance, if the stock have gone up 10% in the last quarter, they must be hot. I should buy in. Unfortunately, that's buying high. On the other hand, people often instinctively sell when an investment drops rapidly. They see losses over the last month or quarter and they get scared and panic. That's selling low. Buying high and selling low are strategies that are going to fail you over and over again. A much better approach: ignore the lows and highs, follow a good strategy while doing your investment. Number 5. Reacting to the media. The media always loves to hype things. The media also loves to hit that panic button hard. One day, they will work to convince you that you need this or that investment because it's the hottest thing in the town. The next, they'll tell you that everything is falling apart and the sky is falling. Usually, neither one is true. The media simply knows that hype and fear are the things that attract viewers and readers. Be calm and measured. Don't fall for the media hype cycle, especially when it comes to your investments. Number 6. Letting emotions get in the way. The worst investment decision is based on emotion, and those emotions can come from a lot of places. They can come from fear about the future. They can come from anger or sadness regarding your key life relationships. They can come from how well things are going the moment. The best investment plan is one that considered with minimal emotion and one that you stick to throughout those emotional highs and lows. Thank you.